Right, good evening, ladies and gentlemen. We've been having a bit of a countdown because with presentations these days, there's webcasts, there's linkages, there's all those sorts of things. But on behalf of the Investment Analyst Society, I'd like to thank the Nedbank Group Limited for this presentation of their annual results. I see they've done it already to the President behind me, but it might have been another occasion because they're all very happy, so I'm not... I'm not too sure. Okay, so this is the results for the year end December 2019. This is a bank been listed now since for more than 50 years, and it's been in operation for 130 plus years. These conditions are probably as tough in many ways as the bank's faced in its history. So we'd like to hear about that. And on behalf of the society, then I'd like just to thank Nedbank for hosting us and to invite the CEO, Mike Brown, who I see has been on the board, CFO since 2004 and the Chief Executive since March 2010. So we have the most experienced and I think one of the most respected people in banking to come and host the presentation. Mike will introduce the rest of these team as they go through. Thanks very much.
Right, I think he just said those nice things because his name's also Mike Brown. But just in case you were wondering, that is actually the launch of Nedbank's participation in the Youth Employment Scheme. So why those kids are looking so happy is it's the first time they've had the opportunity to have a job and earn a real income. Okay, so good afternoon to everybody here at the Boardman Auditorium in 135 Rivonia Road, also to those people who are watching over the web or on the phone lines. As usual, I'm going to start with a high-level overview of the environment, progress on our strategy, and our 2019 results. Our Chief Financial Officer, Rasibi Marathi, will then stand up and take you through the detail of those results and the underlying drivers. And then each of our cluster managing executives will report on their results and their outlook for their respective clusters. I think also particularly pleased this year to welcome here Anel Bosman, who's the new managing executive of our CIB business, who will be taking over from Brian Kennedy at the end of March. And she will do the prospects section for CIB, as well as Terence Sabir, who currently runs our Nedbank Africa regions, and he's also joining Group Exco from the 1st of March, and he will similarly do the prospect section for Nedbank Africa regions. I'll then come back at the end to reflect on our current expectations for 2020 in a global and domestic environment that we expect to remain difficult, and what this means for our medium to long-term financial targets, and then there'll be some time for questions at the end. So looking at our performance for 2020, I think we made good strategic and operational progress and produced solid underlying growth in key aspects of the franchise, but our financial performance was below our expectations. Starting on the strategic and operational front, we continued with our focus on technology investments and digital delivery. Collectively, we call those the managed evolution, as a means of enhancing client experiences, growing and protecting revenues, as well as improving efficiencies. We are building a bank with the capability of leading in digital financial services, with customer experience at the heart of our strategy. I'll provide a little bit more color on that in the next few slides, particularly on the delivery of our new retail digital onboarding platform, which was a huge operational focus for us, in particular in the second half of this year, as well as client satisfaction outcomes and progress on existing efficiency initiatives, as well as some additional efficiency initiatives that we will be able to undertake as our technology platform rolls out. Advances, assets under management, and deposit growth was pleasing, showing the underlying strength of the franchise. In this difficult environment for both revenue growth and impairments, costs, we believe, were well controlled at only 2% up. Pre-provisioning operating profit was up 3%, and our optimisation efforts on costs, together with a 25% reduction in variable pay, which we think is appropriate in the tough times that we are in, assisted us to have positive operating leverage, or JAWS, and we continued as a result to improve our cost-to-income ratio, now at 56.5%. Executive salary increases in 2020 have been agreed at 0%, again underpinning our ongoing focus on cost control in a tough economic environment. Our Common Equity Tier 1 or CET1 ratio, the regulatory capital ratio, ended the year at 11.5%, which was an improvement from the 11.3% in June, and supported a total dividend for the year at R14.15, which was flat on the prior year. Reflecting on our financial performance at a high level, headline earnings was down 7%. The impact of the more difficult macroeconomic environment was greater than we had expected it to be, and was evident in muted client activity across all of our clusters, with the slowdown increasing in the second half. Impairments increased off a low base to slightly above the midpoint of our target range, showing cyclical increases in retail and business banking and increased impairments on a few existing CIB watchlist clients in the fourth quarter, as well as an increase in our central provision in the fourth quarter. In addition to that, a few large items impacted the results, including accounting in December for hyperinflation and impairing legacy intercompany assets in Zimbabwe that are registered under the so-called RBZ legacy asset regime. We also had negative private equity revaluations as the impact of underlying deterioration in performance in investee companies, coupled with lower multiples or higher discount rates, resulted in a decline in private equity income, as well as the cost of accelerating an option to increase our share in Banco Unico from just over 50% to just over 87%. Rasivi will unpack each one of those in detail a little bit more later, together with the exact headline earnings impact of them. So turning now to the overall environment, I think this is a slide you should be familiar with, highlighting our view of the stages of the South African turnaround story. Unfortunately, we're still very much on the left-hand side of this story. Progress has been slow, and we are at the early stages of an institutional turnaround. Progress on structural reform and policy certainty remains far too slow, and I'll touch on this on the next slide. And as a result of that, confidence levels are low, investment levels are low, inclusive growth is still elusive, and unemployment levels continue to rise. So in this context, South African economic growth in 2019 was much lower than we had expected it to be. If you see on the slide here, when we started the year, our forecast for growth in 2019 was for it to improve off the low base of 2018. You may recall that was 0.8%, to finish the year at 1.3%. During the year, we consistently revised those forecasts down, as you can see on the slide, as frequent power outages and ongoing policy uncertainty impacted confidence, investment, and therefore GDP growth, which in this slide we forecast to end the year at 0.3%, and I'm sure all of you saw this morning came out slightly lower than that at 0.2%. We are currently in the longest economic downswing in South Africa since economic records began in 1945, which is an economic and jobs crisis that requires urgent action. The elephant in the room remains the unsustainable operational and financial position at Eskom that needs to be urgently resolved, failing which we will be stuck in a 1% economy, and as a result, unemployment levels will not improve. In addition, our unsustainable fiscal position and the increasing risk of a Moody's downgrade, along with policy uncertainty, and in particular the gap between policy pronouncements and policy and underlying legislative enablement, is likely to continue to impact negatively on GDP growth in South Africa, with our forecasts for 2020 at 0.7% and 2021 at 1.1% respectively. Looking at this from a client point of view, on the wholesale side, the key issues remain a lack of business confidence, with the latest levels around 26, which is a 7-year low, And as a result of that, we see muted investment activity with the generally difficult macroeconomic environment playing out in company earnings that are under pressure across most sectors in South Africa, as well as insolvencies that are increasing. Most of our corporate clients are currently focused on conserving capital, cost reduction, and efficiencies in a very difficult environment. Turning now to a retail client perspective, we've seen a slowdown in disposable income growth as evidenced on this slide, which simply means less money to spend and increased pressure on loan repayments. The drivers of this slowdown include slower nominal wage growth, the impact of the tax increases in 2019, as well as weaker spending and high levels of unemployment. On the more positive side, household debt levels have remained relatively stable at around 73%, and lower interest rates have been beneficial at the margin to some consumers, although not big enough to have any impact on the overall economy at large. On the strategy front, again, this should be a familiar slide that we refer to as the spine of our strategy. Our central focus is to create great client experiences and as a result, grow our client base faster than the market in key value-creating areas, with a key focus on our transactional and related deposit franchises. We aim to enable this through our investments in technology, as well as the changes that we're making to our people practices and to our brand. And again, given its strategic importance, I'm going to touch a little bit more on our technology journey in some of the next few slides. A key benefit of this strategy is the efficiencies that we are able to achieve as the technology rollout accelerates. Investors will be familiar with our target operating model, or TOM. We've got TOM 1.0, and that is currently delivering in excess of the expected efficiencies in the organization, at a run rate at the end of 2019 of some 1.1 billion rand, ahead of our target of 1 billion rand, and we're on track to exceed our 1.2 billion rand target that we had set for the end of 2020. As our IT rollout continues, and as client adoption of more digital interactions with us increases, we are currently in the process of strategizing around what we call on this slide TOM 2.0, as we plan to revise and optimize our approach to branch infrastructure, to move to a more client-centric model in retail and business banking, and optimize shared services across the group. The targets for this initiative that will replace TOM 1.0 that ends at the end of 2020 will be announced to the market alongside our 2020 year-end results presentation. I think this focus on ongoing efficiencies will become increasingly important in a difficult macro environment. And together, these strategic enablers help us to deliver on our medium to long-term financial targets. So looking quickly at the progress on our tech or managed evolution strategy that underpins our digital ambitions, as well as our ability to harness the efficiencies of TOM 1.0 and TOM 2.0. Just a quick reminder here, we started out in 2010 when we embarked on a best-of-breed journey and strategy to digitize our IT landscape, and in so doing, to rationalize, simplify, and standardize our core systems from what was then around about 250 to somewhere between 60 and 75 over time by 2020. We've made good progress on this, and we expect to be materially complete by the end of this year. Again, this is the third time we show you exactly this same slide, which is tracking our progress on completion of the managed evolution strategy, and we'll keep showing this until we are materially complete. In the bottom left-hand corner, you can see total spend to date is now 9.6 billion rand, up from 7.7 billion in December 2018, and that represents a 70% completion rate, up from 60% the year before, and we aim to be around about 80% complete by the end of this year, with in excess of 90% completion of what we call the foundational systems. Annual cash flow spend on technology peaked in 2017 and is expected to reduce more strongly from 2021. We made good progress across all of these programs during 2019, with the implementation of our retail onboarding system that we call Eclipse a key highlight, and more of this on the next few slides. So in the first half, if you look at the top of this slide, we began to accelerate the rollout of Eclipse. a simplified end-to-end client onboarding system for retail customers as part of our overall plan to digitize our top 10 products and top 180 services. It really is a material change to the way that we onboard and sell products to customers, moving from an inefficient paper-based process to onboarding clients once for life, fully automated across front, middle and back offices, resulting in much quicker onboarding, much higher prospects of cross-sell, digital FICA, as well as a significantly lower cost to onboard customers. This was a huge technology, operational and training focus for us in the second half of this year as we launched this capability to individuals, more than 3,400 individuals in our branches across 589 branches, and then in the second half also onto the app and onto the web. At the same time as we rolled out the onboarding capability, we rolled out the ability to digitally sell a transactional account and a personal loan, and we supplemented that at the end of the year with pilots in cards, investments and overdrafts. After this rollout, we had some initial stability challenges, but managed to resolve those quite well and actually had a very good outcome over Black Friday and over the Christmas period across our new Eclipse systems. Slightly further to the right, you'll see juristic onboarding, which is rolling this out to small and large corporates. Currently, this is in pilot in our retail and business banking division, and we expect during 2020 to roll this out to our CIB business. The initial feedback on Eclipse in a relatively short time frame has been pleasing. Client feedback has been really good, and we're seeing the benefits of significantly reduced account opening times at around 10 to 20 minutes now for a transactional account and a personal loan, and under half that for somebody who's an existing customer opening a transactional personal account either on the app or on the web. The data on the right represents the progressive sales outcomes in the last 3 quarters of 2019 as we matured our processes and operationalized our digital channels. Towards the end of the year, if you look at the very 2 far right-hand Manhattans, you'll see 75% of all personal loan sales across the bank were done on either Eclipse or the app, and 79% of all transactional sales across the bank done on either Eclipse or the app. From a financial point of view, this is our slide on delivering value to shareholders, the key drivers of value creation in a bank. Our performance across all of these in 2019 was below our expectations. Net asset value grew by 4%, and our return on equity declined on the back of the fall in headline earnings that we saw earlier, but remains above our cost of equity. Despite the reduction in earnings, our solid capital position enabled us to declare a final dividend of R6.95, bringing the full year dividend to R14.15, flat on the prior year. Finally, from me, a slide on the important role that Nedbank plays in delivering holistically to stakeholders and evidencing our purpose statement. In the current South African environment, this view of purpose and sustainability is vital as the social license to operate. It's also well aligned to the sustainable capital theme that was espoused by global CEOs in Davos this year, as well as the social compacting theme that was evident in the State of the Nation addresses. Lots of data on this slide, but just a couple of aspects. Starting in the top left-hand corner on the staff front, we continue to invest in our staff as we prepare our business for a digital and technology journey. As a responsible employer, we worked very hard to minimize retrenchments in an environment where our overall headcount reduction of permanent staff in 2019 was 1,664. This was mostly achieved through natural attrition, with only 158 retrenchments. Pleasingly, our latest staff survey highlighted that our engagement scores were strong and the demographics of our workforce continues to transform. On the client front, we did remain firmly open for business with 208 billion rand of new loan payouts, which were up 15% on the prior period, and we continue to support our customer base, in particular in more digital and self-service ways, as well as through various innovations, including launching South Africa's first zero-fee monthly account. On the top right, after our share price outperformance in 2018, we were disappointed that our share price underperformed the FINI in 2019. Dividends paid to shareholders remain attractive. We proactively engaged with shareholders and were pleased with our AGM voting outcomes and ongoing engagements with regulators. ESG matters certainly remain top of mind for shareholders, and we continue to play a leading role in environmental matters and plan to proactively table resolutions on climate change at our upcoming AGM. We remain focused on serving and supporting communities in which we operate, and in addition, as you saw from the slide right in the beginning, have been a material contributor to the Youth Employment Service, and were also pleased to retain our Level 1 BBBEE status in 2019. I'll now hand over to Rasibi to take you through the drivers of the financial results.
Good afternoon, ladies and gentlemen, and thank you, Mike. Our financial performance reflects the impact of higher impairments and various large items. A number of these items occurred at the end of the year, impacting our pre-close guidance. Our headline earnings decreased 7%, and most of the key financial metrics were softer, deriving from the earnings pressure. Diluted headline earnings per share was down 6%, benefiting from buying back approximately 7 million shares post the odd lot offer on the back of managed separation. Our economic profit was impacted by the reduction in earnings, whilst ROE and ROE excluding goodwill declined to 15% and 16% respectively. Pleasingly, our pre-provisioning operating profit increased 3% and our cost-to-income ratio improved to 56.5%. As expected, our net interest margin decreased, whilst our credit loss ratio was higher than expected, around the midpoint of our through-the-cycle target range. I will unpack this in a bit more details later. Pleasingly, our CET1 ratio improved from the H1 level to 11.5%, although down slightly on 2018. This waterfall graph highlights the key drivers of headline earnings. Our revenue growth was muted, with NII increasing ahead of inflation, but NIR was impacted by inter alia private equity. Cost growth was well contained. Impairments increased 66% off a low base, including some lumpy counters in CIB. Strong growth in associate income was underpinned by ETI's base in 2018, although their Q3 in 2019 was lower than our expectation. Included for the first time in this results is the impact of hyperinflation accounting for our operations in Zimbabwe. The impact was a net monetary loss of just under 300 million, recorded as a new line item on the income statement, similar to industry practice. The headline earnings loss was 142 million rands. And again, I will unpack some of the key drivers later. Various large transactions impacted the group's results. In our first half, we noted the residual PRMA benefit, once-offs in Africa regions, and the initial impact of the Youth Employment Service. In the second half, Youth Employment Service run rated for the full year, and we accounted for Zimbabwe hyperinflation and legacy debt at 186 million rands, and accounting for exercising the Banco Unico option at a cost of 140 million rands. Private equity revaluations had a larger than expected impact from lower valuations, as well as strong base in 2018. And here we show the decline from two largest negative private equity revaluations in CIB. Similarly, impairments were higher than expected, and we show the impact of three of our largest impairments in CIB, which occurred in the fourth quarter. Our NII increased 5%, supported by average interest earning banking assets growth of more than 8%. And this was driven by solid growth in advances and higher levels of high-quality liquid assets. Our NIM decreased by 13 basis points to 3.52%. This decrease was primarily driven by a negative endowment impact, negative asset pricing from the personal loans pricing caps, and competition for wholesale assets, and the implementation of IFRS 16, which came into effect January 2019. The decrease was only partially offset by improved asset mix as average retail advances grew faster than wholesale. Our banking advances increased 7%. Taking a product lens, term loans increased strongly year on year as the CIB pipeline converts and we benefit from renewable energy drawdowns. Commercial property grew at 8%, losing market share as we focus on quality assets at appropriate pricing in a difficult property market. Retail advances growth momentum continued as seen in solid increase in vehicle finance and personal loans, whilst home loans is reflective of slow industry growth. Other loans comprised of preference shares and other short-term loans was down 14% due to reduced demand from clients. Deposits grew 9% ahead of advances, improving the group's loan-to-deposit ratio to 88%. Through active management, RBB and CIB deposits grew ahead of nominal GDP. Africa region deposits was impacted by the depreciation of the Zimbabwean currency versus the rand. All liquidity ratios remain well ahead of the minimum regulatory requirements. Returning to the income statement, NIR was flat, reflecting solid underlying growth of the franchise, but offset by the impact of private equity. Growth was underpinned by commission and fees that grew 3%, supported by solid underlying retail transactional growth of 6%, while CIB was impacted by a high 2018 base and subdued client activity. Trading income grew 2%, notwithstanding low market volumes and low levels of volatility. Our insurance income is marginally down on the prior year as good sales volume increases were offset by the higher weather-related claims in the first half. Private equity was impacted by revaluations in specific counters, while 2018 had a strong year. Other NIR includes the impact of the option in Banco Unico. Turning to credit loss ratio, the graph on the left provides an overview of the credit loss ratio increasing 29 basis points to now 82 basis points, which is at the midpoint of our 60 to 100 basis points through the cycle target range. The cyclical effects are reflected in the upturn since 2017. The key drivers were CIB and RBB increasing off a low base to within the lower end of their respective through the cycle target ranges. Impairments increased 66%, driven by increases across stages 1, 2, and 3 impairments, and we increased our central provision by 150 million rands in the second half to take account of risks that have been incurred but not yet emerged. Turning to stage 3 advances, over the past 12 months, defaults increased by 10% to almost 28 billion rands, representing an NPL ratio of 3.6%. As can be seen on the left, the increase was consistent over each 6-month period. CIB defaults reduced, while stresses were most evident in our RBB portfolio. Stage 3 coverage increased to 38% compared to December 2018. Expenses increased 2%, driven by reduced incentives, which decreased faster than earnings. IT investments in the business continued to drive cost growth, but were partially offset by ongoing efficiencies. Our headcount reduced by 6%, largely in RBB, and this was mainly through natural attrition. Our participation in the Youth Employment Service from the end of April 2019 brought a new cost of 134 million rands. The final PRMA settlement resulted in the 354 million rands benefit for this period. Coming to hyperinflation, in October 2019, the Zimbabwean Public Accountants and Auditors Board announced that Zimbabwe is in hyperinflation effective from the 1st of July 2019 as a result of CPI exceeding 200% in the month of July. Consequently, Nedbank applied IAS 29 in accounting for our operations in Zimbabwe, where we hold 66% of the company's equity. The key drivers included adjusting opening equity with the closing CPI at 6.2 times, and similarly reducing the income statement by 246 million rands, and this adjustment had no impact on NAV. Further adjustments were from indexing of non-monetary assets, such as fixed assets, and our income statement. The overall HE impact of these adjustments is 142 million rands after adjusting for minorities. The headline earnings loss is driven by inflation as well as weaker Zim dollar versus the rand. The NAV of Nedbank Zimbabwe as at 31 December 2019 was 123 million rands, which is immaterial on the Nedbank Group's balance sheet. As reflected in my earlier slides, associate income continues to reflect progress at EcoBank, although their third quarter results were lower than the previous quarters. Our carrying value declined further by approximately $500 million, as associate income was offset by FCTR and OCI changes. Given the carrying value of our investment in ETI being above the market value, we continue to monitor the valuation of this investment at each reporting period for inter alia indicators of impairment. At this stage, our value in use calculation slightly exceeds our carrying value and therefore supports the book value of our investment. The group remains well capitalized at levels significantly above the minimum regulatory requirements. The CET1 ratio of 11.5% is at the midpoint of our board-approved target range. However, this was impacted by the implementation of IFRS 16, the ongoing investment in software development as part of the group's managed evolution program, the adverse impact of changes in currency translation reserves, and adverse migration in certain credit portfolios. Our dividend was paid towards bottom of our target range, and we foresee continuing to pay future dividends within our target range. And our final dividend, as stated by Mike, was 695 cents per share. Our dividend yield suggests that Nedbank should be attractive for investment. A brief overview of our performance in the clusters show a decline in headline earnings across all our frontline businesses, and each managing executive will unpack their performance shortly. My last slide is just to unpack the center. The movement in the center reflects a 72 million rands post-tax impact from the increase in the central provision, the net PRMA benefit, the first-time cost of youth employment service, as we offered first-time job opportunities to over 3,000 youth, and, as previously mentioned, the Banco Unico option. I thank you and would like to hand over to Brian Kennedy to take you through some of the insights on CIB's performance.
Thanks, Rasibi, and good afternoon to everybody. CIB's gross operating income was maintained at 15.7 billion, which was a fair result given the economic conditions and the solid 2018 base. Headline earnings, however, declined 8.1% to 6.2 billion as the credit environment deteriorated further in the second half of the year and corporate impairments increased accordingly. Property finance impairments remained resilient at -2 basis points. NII grew 2% as a result of good advances growth in our term lending portfolio, but was impacted by declining margins due to competition amongst the banks for high-quality assets. Expenses were very well contained with less than 1% growth. Total NIR fell 4.1% to 8.2 billion, mainly due to revaluations in the private equity income line as the economic environment impacted certain counters. I'll cover this in more detail in the next slide. The credit loss ratio increased to 26 basis points, normalizing to our through-the-cycle target range of 15 to 45 basis points. Our cost-to-income ratio of 42.1% remains highly competitive, and we continue to invest in talent whilst capitalizing on digital opportunities to ensure an improved client experience. The ROE decreased to 17.7%, mainly due to the increase in impairments, as well as a 4% increase in economic capital. Total NIR was impacted by revaluations in our private equity income. The decline in private equity income line was a result of certain counters' valuations decreasing due to the performance, as well as the economic environment worsening over the second half of the year. The private equity line includes the private equity business in investment banking, the private equity arm of the property finance business, as well as our exposures to listed equity counters. Trading income grew 2.6% despite low volatility and decreased volumes from a high base in 2018, with some once-offs compensating for slow markets in 2019. Focused investment in the market sales and trading franchise over the last 4 years has built a dominant SA markets business, and it is emerging as a market leader in key areas such as flow and structured capabilities in both equities and fixed income, as evidenced in market share, awards, and client feedback. We grew our primary bank clients with 32 new primary bank wins, which contributed to growing our transactional base, which forms part of the fee and commission line. This was offset by subdued client activity in other areas. This slide sets out the continuous improvement journey over the last 4 years in terms of major league tables. In the left-hand column, you can see the 2015 column on the left, which shows our rankings in various categories, and particularly low-ranked or no rankings indeed in some categories. If you move over to 2019, you can see that in most categories we've moved to either number one or very close to number one position, and this is illustrated how we have invested in the franchise over time. It's also pleasing to note that in the last Deal Makers, we were ranked first by deal volume for M&A advisors and also won BE Deal of the Year in the recent awards. We also had a strong showing in the JSE Spire Awards, and our dominance in the fixed income asset class and the continued growth of the markets platform were reaffirmed. We've continued to be a significant debt provider to corporate South Africa, with growth of 9% in actual banking advances, including corporate bonds, as we closed significant deals during 2019 and maintained market share. NIM decreased to 1.99% from 2.12% in December 18, with asset margins coming under pressure as we continue to target high-quality assets. Investment banking had strong growth due to pipeline conversion, as well as continued drawdown on existing deals. We also continue to focus on selective origination in property finance, with good growth in advances as a result of deals finalized in the latter part of the year. The pipeline remains fairly robust across sectors, with an expected uplift when the cycle turns. It was pleasing to note that both the investment banking and property finance teams were recognized with various awards in 2019. The credit loss ratio at 26 basis points has normalized to our through the cycle target range of 15 to 45 basis points. It continues to highlight the quality of new business, proactive risk management, as well as a constructive involvement with clients to restructure and resolve distressed assets. The portfolio coverage ratio on the performing book increased from 28 to 36 basis points, as increased economic pressure resulted in the deterioration of risk ratings for counters in stressed industries such as cement and construction. Our early engagements and initiation of restructure of clients in 2018, as well as no new significant defaulted clients in 2019, resulted in the defaulted balance decreasing from 5.7 billion to 4.1 billion. However, the worsening environment has resulted in increased corporate impairments and a higher specific coverage ratio against these remaining counters. We will continue to closely monitor stress sectors of the economy this year, such as construction and cement, commercial property clients with large office or government exposures, and parts of the retail sector. Focus will also continue on certain SOEs, as we remain concerned about the constrained fiscus in funding and executing definitive turnaround plans proposed by the boards of the SOEs, who continue to be impacted by liquidity and debt repayment concerns over the medium term. More information is included in the booklet slide. Turning to prospects, I'm very proud to hand over to our new ME of CIB, Anel Bosman. I've worked with Anel for over 20 years, and I have every confidence in her ability to take Nedbank CIB to even greater heights. I wish her and the team all the best for 2020 and beyond. And I'd also like to take this opportunity to thank Mike and the Nedbank board for their continued support over the last many years in building the CIB franchise. Thank you very much. Anel.
Good afternoon, and thank you, Brian. It has been a privilege to work with you, and it is indeed a great honor to step into this position. You leave us with a powerful business, and we will continue to build on our strengths to ensure that CIB remains a formidable competitor. I'm very proud of the markets team and our expansion, the quality of our people, our technology innovation, and the financial performance over the last 5 years. I thank each member for driving our strategy, your hard work and support. We will maintain the momentum of client acquisitions and our technology drive over the next year. Looking at our other businesses in CIB, property finance has maintained its leading position in South Africa, and we will build on this through both our debt and equity capability. We have invested extensively in expertise to meet our growth ambitions northwards into Africa, and we expect to capitalize on this going forward. Investment banking has built deep expertise in many specialized sectors, which will be instrumental for expansion in SA and across the continent. Despite the headwinds in 2019, the underlying business is solid with an excellent pipeline. We will also continue to build on our advisory business as it is a key enabler to NIR. Transactional banking remained focused on client solutions and product innovation, allowing our clients to manage their various products better and to interact with us in a more effective and digital-friendly manner. We have exciting projects that will deliver on this promise. Our strategic focus areas for the future of CIB is summarized in the 4 pillars shown. Client centricity and our strong client relationships are driven by client coverage, and we plan to intensify our efforts through our sector-aligned approach by providing innovative and value-adding solutions. We are committed to sustainability, and we believe that CIB is well positioned to use our expertise to play a part in achieving a sustainable future. In 2019, we concluded the first issue of a green renewable energy bond in South Africa, and we will maintain our lead in the renewable financing space. Our attention will also be on efficiencies and optimization, including costs, capital, and ways of working together. We will continue to invest in key areas such as technology and skills. Lastly, we will further diversify revenue outside of South Africa by increasing our presence on the rest of the continent through our sector expertise and strategic partners. Our medium and long-term targets for ROE are set at bigger than 18% and 20%, and cost to income at less than 42% and 40% respectively. Thank you. I will now hand over to Tika Thomas to deal with RBB.
Thank you very much, Anel. Congratulations once again on your appointment. Good afternoon, everyone. Retail and business banking headline earnings decreased by 2% in this period, with quality headline earnings adversely impacted by a higher impairment charge. Pleasingly, in this tough trading environment, pre-provisioning operating profit is up 11%, driven by NII growth of 6%, coming off the back of pleasing growth in both advances and deposits, NIR growth of 6% from both higher transactional volumes and lift from average pricing increases, expenses growing at a judicious 2%, this after including for our continuing investment in physical and digital distribution as we continue to drive a strong ongoing focus on active management of costs. The credit loss ratio increased to 138 basis points in this period. It does, however, still remain at the lower end of our target range of 130 to 180. Allocated capital is up 7%, in line with growth in advances. The decreased earnings, however, due predominantly to impairments, have translated into a lower ROE of 17.3%. In consumer banking, headline earnings are down 3%, impacted by normalization in impairments from the low relative base of 2018. There was strong growth in pre-provisioning operating profit, up 13% year-on-year, supported by good growth in advances and deposits, and also benefiting from the judicious management of expenses I referred to in an earlier slide. Growth in impairments off the low base of 2018 has been a big factor in the headline earnings decline in this segment. The continuing focus on clients and client experience has seen improved customer metrics. I will discuss this improved matrix later in this presentation. Business banking delivered strong pre-provisioning operating profit growth of 14%. This growth number excludes the effects of internal client migrations to RRB. Headline earnings growth, however, remained flat due to higher impairments, compounded as they were by the once-off impairment releases in the 2018 base. There was good growth momentum evidenced across assets and liabilities. It was also pleasing to see continuing client number growth, especially off the back of refreshed value propositions in key sectors like franchising, agriculture, and the public sector. In retail relationship banking, we continue to see good growth momentum evidenced across all lines, transactional, assets, and liabilities. Headline earnings grew by 29% for this segment. RRB has benefited from the migration of clients from BB during the second half of 2020. The matrix shown here, however, are normalized for this and exclude the impact of this transfer. Encouragingly, we continue to see steadily improving customer matrix and market perception of our relationship client value proposition. Let's now focus on impairments. Impairments in retail and business banking increased by 40% in this period. This is attributed largely to a normalizing impairment cycle in a deteriorating macroeconomic environment, as well as regulatory impacts, primary amongst which is the ruling on the treatment of set of payments in credit agreements implemented at the back end of 2019. Consequently, the credit loss ratio increased by 32 basis points, albeit off a low base, and is now back to within the lower end of the target range as risk normalizes. Impairments in MFC increased due to higher repossessions and the subsequent write-offs. In business banking, the increased impairments are largely the consequence of a low business confidence environment, but also there is included the impact of once-off releases in the 2018 base. The overall credit loss ratio in retail and business banking at 138 basis points is however still within our target range of 130 to 180. RBB has a well-managed asset book. However, we remain alive to downside risk in a challenging macroeconomic environment. Pleasingly, retail banking transactional NIR has grown by 6.3% despite the moderate reduction in main bank clients and moderate sub-inflation price increases. Total client numbers are flat as seen on the slide. This is due largely to the accelerated closure of dormant accounts. In this slide, we unpacked our main bank client number, down by 1% in this period by each of the segments. Middle market, professional and small business clients continued to increase strongly, which has contributed to the growth in NIR. The entry-level main bank segment has shown a marginal reduction of 2% after 5 consecutive years of 3% compounded annual growth. Growth operating income for this segment has also grown, however, by 5.5% in this period. Concerningly, the youth main bank clients have declined by 10%. We have, however, continued to release several new and disruptive value propositions to stem this decline. These include Unlocked.me for the youth, launched in January 2019. It's a proposition that delivers banking value through a 0 monthly fee account. Uniquely also, Unlocked.me also delivers lifestyle value relevant to the youth through great deals on tech and fashion, as well as assisting clients to unlock their career potential with job search support, including access to up to 500 jobs online through our partnership with MoveUp and GradesMatch, a unique and powerful proposition that we back to stem and reverse the decline. Following the early success of the Unlock.me account with students, we have now opened the proposition up to all young adults between the ages of 16 and 26, so that we can fast-track acquisition and minimize attrition in the overall youth base. We also continue to work hard to migrate the youth customers onto the other products that are driving attrition. Delivering delightful client experiences continues to receive major focus in RBB. To this end, it is pleasing to see that we continued to make significant improvements in our key client satisfaction measures: Net Promoter Score, SAXI, as well as social media sentiment. For the second year in a row, Nedbank posted the largest improvement on the Net Promoter Score survey. Nedbank's SAXI improvement was the largest of any of the big five banks, rising to 80.2% in 2019 and moving to number 2 overall. Nedbank was rated number 1 on social media net sentiment with a score of 20.4%, the first time we have as a bank attained top position on this important measure. A further highlight from SAXI was Nedbank Home Loans outperforming the industry, rising to number 1 in customer satisfaction. Nedbank Home Loans also had the best performance improvement in NPS, with the bank also placing second across the home loan industry in NPS. We have successfully launched several innovative products and solutions during the year, 4 of which I have highlighted on this slide. Reading from left to right, these are digital onboarding on Eclipse across multiple channels, which Mike spoke to earlier, the digitized home buying journey in our home loans business, the lending API, which is the first on the African continent in the personal loans business, which allows other e-commerce platforms to use our lending APIs to offer loans. And finally, we relaunched a revamped and improved Greenbacks Loyalty and Rewards program in H2 of 2019, launching with the Card Swiper package. We shall launch more packages over the course of 2020. Digital sales have increased, with digital active clients increasing by 15% in 2019. We have also seen a big uptick in Money app downloads, as well as an increase in the number of active users now using our app. We continue to see cash migration from the physical branch environment to self-service devices. Cash through our self-service devices is up 20% in this period. Further, third-party payments coming through our Money app are up 80% year on year. And finally, digital value-added service volumes are also pleasingly up by 29% as we continue to leverage digital to make it easier for our clients to transact. This slide reflects how we continue to unlock digitization to drive further optimization in our process and operational environment. Headcount has been actively managed in this journey of digitizing our operations, with reduction being absorbed through natural attrition. Only 145 retrenchments were effected in retail and business banking in 2019. Also, actual space reduction of over 42,000 square meters was achieved at the end of 2019, representing 23% of the Nedbank branch floor space we occupied in 2014 when we began this optimization through digitization journey. The total number of retail outlets has also reduced by 2.5% from the previous year to now a total of 589 retail outlets. The implementation of robotic process automation continues apace. In RBB, we have now implemented over 125 RPA processes cumulatively since 2017. We shall continue to drive this transformative digitization journey through the work we are driving in the TOM 2.0 program that Mike referred to earlier in his section. And finally, on to prospects for the rest of 2020 and beyond. We remain committed to our client-centered growth strategy. and on boldly executing our plans to deliver delightful client experiences through the digital transformation of RBB using the 5 strategic levers reflected on this slide. The targets we had set for 2020 will be delayed. We have reset them as expressed in the slide for the medium and long term. Our focus, however, remains on accelerating the adoption of our banking propositions to meet evolving client needs by commercializing existing CVPs and continuing to develop new and innovative value proposition, delivering competitively priced products, actively reducing transacting costs for our clients through digital banking services, investing in a frontline people cadre that delivers excellent client experiences, and lastly, in tapping into platform-based propositions to offer beyond banking solutions for clients. Thank you very much, and I'd like to hand over to Ayolanda.
Thank you, Tiko, and good afternoon, everyone. Nedbank Wealth's headline earnings declined 8% to 1,042 million rand, with ROE at 24.8%. NII increased 3% as a result of steady balance sheet growth in the international wealth management business, offset by a decline in US interest rates. NIR decreased 1.4% due to lower brokerage and portfolio management fees in wealth management local, margin pressure in asset management, and an increase in non-life claims in insurance. Expense growth was well contained at 3%. The difficult environment locally contributed to an increase in impairments in Nedbank Private Wealth, resulting in a marginal increase in the credit loss ratio to 18 basis points. Taking a look at our divisional performance, overall wealth management headline earnings declined 14% to 252 million rand on the back of a reduction in local market activity negatively impacting brokerage fees, with portfolio management fees and commission income declining due to clients de-risking to lower margin products. Wealth Management International achieved good underlying growth in AUM and a steady growth in deposit balances, whilst advances declined due to the continued Brexit uncertainty and increased competition from ring-fence banks. In the 2020 Euromoney Private Banking and Wealth Management Survey, the local Nedbank Private Wealth business was named top private bank and wealth manager in South Africa for ESG, impact, social investing and philanthropic advice. Internationally, Nedbank Private Wealth was named Best Boutique Private Bank at the 2019 Wealth Briefing MENA Region Awards. Moving on to asset management. Muted equity performance across the local asset management industry over the past 3 to 5 years has resulted in a change in the AUM mix to lower margin, lower risk products. Despite this, Nedbank Group Investments had net inflows of 15 billion rand, with overall AUM increasing 11% to 330 billion rand. The low-cost passive business remains the largest unit trust multi-asset passive provider, while cash and fixed income assets continue to grow with strong net inflows. Headline earnings declined 5% to 319 million rand, mainly as a result of margin pressure. At the 2020 Raging Bull Awards, Nedbank Group Investments was recognised as the top offshore manager for the 5th consecutive year and won the award for the best global equity fund at the 2020 Morningstar Awards. Moving on to insurance. Insurance headline earnings decreased 6% to 471 million rand due to higher non-life claims and a lower life reserve releases, partially offset by an improvement in investment returns. The life portfolio was impacted by actuarial assumption changes relating to an improvement in credit life mortality, worsening for funeral, and an overall deteriorating lapse experience. Growth in life embedded value of 14% to 3.2 billion rand is as a result of an 11% increase in the value of new business on the back of good growth in credit life policy sales and a higher average funeral premium. In the first half of the year, the non-life portfolio was impacted by catastrophic weather events, resulting in a higher overall non-life claims ratio. Non-life gross written premium remained flat at 1.2 billion rand due to pressure on non-life volumes, offset by an increase in vehicle value-added product premiums. Looking forward, while we continue to face economic headwinds, we remain committed to creating value through our international high net worth offering and holistic advice in wealth management, delivering long-term performance through our best-of-breed philosophy in asset management, and expanding our offering and leveraging data and digital capabilities in insurance. We commit to achieving ROE of 28% in the medium and 30% in the long term, and have revised our cost-to-income ratio to 65% due to structural changes exerting pressure on revenue streams. As a result, we will continue to focus on creating internal efficiencies, delivering on client experiences, and building new revenue streams. It now gives me pleasure to hand over to Mfundo.
Thank you, Ayolanda. Nedbank Africa Regions had a tale of two halves in 2019. We started strongly, and headline earnings were up 20% at half year. But we hit the perfect storm in the second half, and headline earnings decreased by 35% to 457 million rand for the full year, resulting in an ROE of 7.7%. This performance was largely impacted by poor results from Zimbabwe, which more than offset the growth from ETI. The SADC business delivered a mixed performance in challenging macroeconomic conditions, resulting in a decline in headline earnings of 94%. The net monetary loss related to hyperinflation and the impairment of legacy debt in Zimbabwe, owing to lack of hard currency availability, gave rise to the negative impact on headline earnings of 142 million rand and 44 million rand respectively. The once-off tax adjustment and non-operational write-off reported in H1 of 2019 reduced headline earnings by 61 million rand, contributing to the negative results. Gross operating income was down 2%, whilst growth in expenses was managed below inflation. Excluding Zimbabwe and the once-off items, earnings from our SADC operations would have been flat. The financial recovery in ETI has resulted in a sustained profitability, albeit at a slower rate of growth. Associate income from ETI grew 10% to 668 million rand, while headline earnings were up 17% to 437 million rand. Following the review of our Malawi business for strategic fit, we concluded that we lacked the benefits of scale, as the business was small in a small market, and executed a sale of the franchise. Nedbank Malawi represented less than 0.1% of our group assets and earnings. In terms of IFRS 5 accounting rules, Nedbank Malawi is held in our books as a non-current asset available for sale. The transaction is at an advanced stage and on course to be completed during H1 of 2020. We increased our stake in Banco Ineco from 50% plus one share to 87.5% to tap into growth opportunities in Mozambique. The transaction is awaiting regulatory approval and is expected to be completed in the first half of the year. The Zimbabwe business was negatively affected by hyperinflation, resulting in a headline loss of 108 million rand, a swing of 250 million rand from the profit of 142 million rand in 2018. This has had a 2% negative impact on group headline earnings. We've begun to reconfigure the shape of the balance sheet and business operation to respond to new market realities. In improving client experience, we rolled out the award-winning Nedbank Money app to our clients in Lesotho, Namibia, and Eswatini. The app offered clients 49 new additional features. In Mozambique, in Zimbabwe, we enhanced our mobile banking solution We have deployed these digital solutions for client convenience and to deliver at a lower cost to serve. As part of our focus on simplicity and convenience, we launched in Namibia the pay-as-you-go account with zero maintenance fees, targeting the entry-level and middle segments. We also deployed a competitive corporate internet banking solution in both Namibia and Eswatini. These new products have been well received in the market as they help to improve client experience. The performance of our business in SADC was impacted by economic growth that was slower than forecast. Zimbabwe and Namibia registered economic declines, and both Lesotho and Eswatini grew GDP below 1.5%. Mozambique and Malawi registered relatively high economic growth of 3% and 4% respectively, but were still below forecasts. In this economic context, average advances were flat, average deposits grew 2%, and NIM squeezed by 27 basis points, reflecting the competitive conditions in the market. The credit loss ratio increased by 50 basis points to 101 basis points, marginally breaching the upper limit of our through-the-cycle credit loss target range of 75 to 100 basis points. Factoring out the strong recoveries in the prior year, the credit loss ratio would have been flat. Non-interest revenue increased by 1% in an environment of sluggish activity levels, and the cost-income ratio increased by 3% to 79%, highlighting the revenue headwinds. Excluding Zimbabwe, most of our financial metrics improved, with average advances up 4%, average deposits up 11%, and non-interest revenues up 5%, reflecting our focus on acquiring primary banked clients. Turning to non-financial metrics in SADC, the business had a marginal decline in client numbers, due mainly to new account closure rules introduced in mid-2019. Notwithstanding, our revenue per client rose 4.5%, reflecting the benefits of deepening client relationships. In line with transforming our business for a digital age, we registered a 94% increase in our active app users and grew the number of point-of-sale devices by 27%, resulting in a 10% increase in merchant turnover to 9 billion rand for 2019. We grew our branch footprint by 5% in high growth and regulatory designated micro markets in Mozambique. ATMs and staff headcount declined 1% respectively as we contained costs in a slow growth environment. On ETI, ETI's performance was driven by sustained recovery from 3 regions, offset by poor performance from the Nigerian franchise. Strong performance in both earnings growth and returns was registered from the Anglophone West Africa and Francophone West Africa regions, reflecting the quality of the franchise in both regions. The recovery in the financial performance in Central, Eastern and Southern Africa region continued, albeit at a slower rate. Nigeria's performance deteriorated further due to persistently elevated non-performing loans, adverse regulatory intervention, and ongoing economic headwinds. And I wish to congratulate and extend my very best wishes to Terence Abia on his appointment as Group Executive for Nedbank Africa, who will now cover prospects for the business.
Thank you, Mfundo, and I wish to thank you for your exemplary leadership of the Africa business over the years, and good afternoon, ladies and gentlemen. We expect the Africa regions to be a source of growth for Nedbank, and we'll continue to leverage the enterprise capabilities to unlock the opportunities on the continent. In SADC, we'll build on our strengths of a strong wholesale client service model, our digital platforms, and strong credit management. In ETI, we'll also build on our strengths in having access to the widest Pan-African network and market-specific insights through the Local Knowledge Africa solution. Our focus in our own managed operations in SADC, we will adapt our businesses to the new economic normal and to drive stronger revenue growth, improved cost control, and capital optimization. We will continue to invest in digital and automation to remain competitive and continue to focus on credit risk management and a much stronger control environment. As Mfundo has mentioned, we've begun the process of reconfiguring our balance sheet in our Zimbabwe operation and also with the increased shareholding in Banco Unico to tap into the growth opportunities in Mozambique. Turning to ETI, while it is pleasing to have reported further growth in both associate income and headline earnings from our investment for this reporting period, risks do persist, especially the drag effect on Ecobank Nigeria on the overall ETI performance. Anglophone West Africa and Francophone West Africa are expected to continue reporting strong results, sustainably generating economic uplift. The recovery in the Central, Eastern, and Southern African region is also expected to continue, although it will be slowed down by the challenges we currently see in Zimbabwe. Our focus will also remain to support the delivery of the ETI board-driven strategic agenda to commercialize the collaboration initiatives such as the cross-border remittances product and increase our business flows between the two institutions. Through our alliance with ETI, for example, around 115 Nedbank wholesale clients now actively bank with Ecobank across various territories on the continent. Turning to our financial outlook, for the next 2 years, we aim to deliver returns greater than 15% and a cost to income below 65%. Over the long term, which is greater than 5 years, we aim to deliver ROEs above 20% and a cost to income less than 60%. I thank you, and I will now hand you back to Mike Brown.
Right, thanks for your attention. We're getting towards the end of the presentation. Just before I conclude, I think two things. Firstly, just to recognize Rasivi Marati and our finance teams for the huge amount of work that goes into these presentations, and in particular because during 2019 we won all 3 reporting awards in South Africa, the Ernst & Young Award, the Chartered Secretaries Award, and the award from the Investment Analyst Society, not only for the banks but also the overall award. So I hope you all enjoy reading that really thick booklet. And then I think also just personally to say a really big thank you to Brian Kennedy for 24 years of service at Nedbank, and in particular the huge role he's played on building an integrated investment banking franchise post the merger of the old Nedbank Capital and Nedbank Corporate that I think puts Nedbank in a very, very strong position today, and the massive contribution he's made to Group Exco. So thank you, Brian. Right, if I have a look at the period ahead now, so these are our latest forecasts for the key macroeconomic data. And for all the reasons I outlined in my earlier presentation, we expect GDP growth to remain weak in 2020 at 0.7%, with higher than forecast load shedding and the currently evolving global economic and health conditions being the key downside risk to this number, clearly as well as the fact that the Q4 numbers that we've just seen were lower than expected. We expect inflation to remain well within the SARB ranges, and as a result, interest rates, which cut 25 basis points in January, in our base case are expected to remain stable, although there is a possibility of another 25 basis point cut further out, particularly if GDP growth remains weak. Credit growth we expect to continue to improve slowly off the low base. Looking now at targets. At the start of 2018, we communicated specific 2020 targets to the market for ROE excluding goodwill being greater than or equal to 18% and cost-to-income ratio being less than or equal to 53%. You can see those in the top right of this slide in the light grey. These will not be achieved in 2020, primarily as a result of the material changes we've seen to the macroeconomic environment from when we set these targets. So just to have a look at those changes, starting in the top left-hand corner, compared to our expectation at the start of 2018, which is when we set the targets, GDP growth in 2020 is now expected to be 2% lower than previously forecast. Credit growth in the bottom left-hand corner, 3% lower. Inflation 1% lower, and interest rates, and as a consequence, endowment also 1% lower. When we model our business, we model it from various stress and scenarios, and actually we are currently in what we modeled in 2018 as the high stress scenario relative to the base case against which we set our targets. So while we have made good progress, I think it would not be sensible or credible to retain the current timeframes that we've set to achieve those targets in this environment. So what we've done now on the right-hand side is set out our revised targets in the bolder, dark font. So starting with return on equity. Firstly, we've changed this metric now to be ROE inclusive of goodwill and not exclusive of goodwill. And we're now going to target greater than or equal to 17% in the medium term, which we define as the next 2 to 3 years, and greater than or equal to cost of equity plus 4 in the long term, defined as 5 years plus. For those of you who know our numbers well, you'll know that this actually aligns very closely with our previous target, as the historic gap between ROE and ROE excluding goodwill has been around about 1%. But the date of achieving that target has now been pushed out from 2020 to the medium term as defined. Similarly, on the cost-to-income ratio, we had set a target of less than or equal to 53% in the medium term and less than 50% over the longer term, as the benefits of rolling out client adoption of our tech strategy emerge. Again, what we've done is said we can't achieve the 53% in 2020, but we will now achieve that over the medium term as defined. Lastly then, turning to the usual format of guidance that Nedbank provides for the full year ahead, based on our current forecast of the macro that you saw on the previous slide, and clearly recognizing the increased forecast risk in global and domestic forecasts in the current environment. For net interest income, we expect average interest earning banking assets to grow just above mid-single digits, and we forecast the net interest margin to remain at similar levels to 2019. On the credit loss, we again expect that to remain at similar levels to 2019. On non-interest revenue, we expect to grow at around mid-single digits, and finally on expenses, below mid-single digits. So if you pull all of that together, and given the 2019 base, we currently expect that diluted headline earnings per share in 2020 will grow around nominal GDP growth, with headline earnings in the first half of 2020 likely to be lower than the first half of 2019, with stronger growth emerging off the base that played out in the second half of 2019. So thanks. I hope that gave you a good tour of the underlying drivers behind what was a difficult year from a financial point of view and a difficult year for the South African economy.